As of August 6, 2026, during active trading hours, UiPath Inc., traded on the New York Stock Exchange under ticker PATH, is changing hands at $13.93 per share, down roughly 1.2% on the session amidst broader technology sector volatility. While most traders looking at screeners see a beaten-down software ticker hovering near historical lows, the reality beneath the surface tells a vastly different story about corporate enterprise architecture. Wall Street has largely written off UiPath as a legacy robotic process automation vendor getting bypassed by generative tech, but modern institutional flow data indicates a massive position consolidation occurring right under retail traders' noses. When you look at popular retail venues, people often cluster around familiar names like Apple stock, Tesla stock, or Nvidia stock when looking for tech exposure. The mainstream consensus around UiPath is that plain vanilla task automation is dead because large language models can simply write code or execute computer actions on their own. The prevailing narrative suggests that enterprise clients will abandon dedicated workflow engines in favor of simple native AI plugins, leaving UiPath with declining renewal rates and shrinking seat counts. That narrative sounds logically sound on the surface, which is precisely why so many casual market participants have walked away from the stock over the past 2 years. However, when you dig into the mechanics of how enterprise technology actually gets deployed in Fortune 500 companies, that surface-level assumption falls apart. Building a clever demo that uses an AI agent to read an email and fill out a spreadsheet is simple, but running that process across 50,000 employees in 30 different countries with strict compliance, security auditing, and legal record-keeping is an entirely different challenge. Large corporations cannot simply give an unmonitored AI model free rein over their core enterprise resource planning platforms without guardrails. This is where the core friction lies between expectation and reality for UiPath. The market expects UiPath to lose pricing power as foundational software models become commoditized, but the reality is that enterprise infrastructure demands an orchestration layer. UiPath provides the precise governance, security compliance, and process telemetry that IT directors require before they let any artificial intelligence agent interact with sensitive financial databases or human resource records. Rather than replacing UiPath, complex artificial intelligence models actually require the structured execution environment that UiPath spent nearly 2 decades building out. If you track recent price action and trading volume across major brokerages like Interactive Brokers or Fidelity, you notice an interesting divergence. While short-term retail volume on platforms like the Robinhood app or SoFi Invest has drifted lower, block trades and institutional accumulation patterns tell a story of quiet positioning. Traders using the Interactive Brokers trading platform or checking institutional holdings on the Fidelity mobile app can see that institutional ownership has stabilized, with major asset managers treating these price levels as a multi-year valuation floor. When you analyze daily market dynamics, stock price fluctuations often reflect sentiment swings rather than fundamental shifts in operational health. Over recent trading sessions, UiPath stock has experienced tight trading ranges with declining sell volume, signaling that aggressive short seller momentum is running out of steam. Earnings reactions over recent quarters have demonstrated a clear pattern where the market overreacts to modest top-line growth deceleration while ignoring steady expansion in non-GAAP operating margins and strong free cash flow generation. Many self-directed traders using an individual brokerage account or platforms designed for self-investing tend to judge software businesses purely on raw revenue growth rates. During the period of ultra-low interest rates, enterprise software companies were rewarded purely for expanding top-line figures at all costs. Today, the macroeconomic environment demands capital efficiency, profitable balance sheets, and sustainable recurring revenue models. UiPath maintains over $2 billion in total assets, 0 meaningful long-term debt burdens, and a cash reserve that provides immense defensive insulation while management pivots towards deeper platform integrations. Let us pause for a quick moment right here because I want to hear from you directly. Comment below how many shares of UiPath stock you currently hold in your portfolio, or tell me if you prefer holding broader market index funds instead. To truly understand where UiPath fits in today's market environment, it helps to review how the underlying business actually generates its revenue. Founded back in 2005 by Daniel Deans and Marius Tirka, the company started as a specialized computer developer tool firm named Deskover before rebranding to UiPath. Its original core breakthrough was developing advanced computer vision technology that allowed software programs to visually read computer screens, identify user interface elements, and imitate human keystrokes and mouse clicks. This technology became known as robotic process automation, or RPA. In simple terms, if a human employee spent 3 hours every morning opening PDF invoices, copying numbers into an SAP database, and emailing a confirmation receipt, UiPath allowed companies to build a software robot that performed that exact routine instantly without human error. Because building deep API integrations between old legacy corporate software and modern cloud platforms is painfully expensive and time-consuming, UiPath offered a quick, cost-effective bridge. Corporations adopted it at a record pace, leading to one of the largest software initial public offerings in Wall Street history back in April 2021. However, the explosive growth of the early years created unrealized expectations. When the stock debuted, public market investors priced UiPath as if it could maintain 40% annual revenue growth forever. When macroeconomic headwinds forced enterprise chief information officers to tighten software budgets, growth naturally normalized into the low double digits. The market punished the stock heavily, knocking it down from its peak valuation, yet the foundational product stickiness remained intact. Once an enterprise wires hundreds of core operational workflows into UiPath, removing that orchestration engine is like trying to swap out an engine while the airplane is mid-flight. Investors seeking solid online investment opportunities or evaluating online investing options often overlook companies going through structural transitions. Many wealth managers utilizing Schwab Intelligent Portfolios or managing accounts through Fidelity Wealth Management look for businesses with resilient net retention rates. UiPath consistently retains and expands its business with existing large enterprise clients, proving that once a corporate customer adopts the platform, they steadily find more business processes to automate. Macroeconomic pressures have also reshaped the software sector landscape. High interest rates have forced chief financial officers to scrutinize every single software subscription line item. Products that are merely nice to have are getting canceled across the board. In contrast, software that directly reduces operational expenditures and automates costly labor-intensive workflows stays at the top of the priority list. UiPath sits directly in the category of cost-efficiency software, making its demand profile far more durable during economic slowdowns than surface-level market headlines suggest. Looking ahead towards the future outlook, the primary catalyst for UiPath stock centers on its evolution into agentic orchestration. The company is actively positioning its platform as the primary operating system for enterprise AI. Instead of viewing new AI technologies as competitors, UiPath is integrating them directly into its Maestro orchestration engine, allowing corporate clients to build, monitor, and audit autonomous agents safely. If management successfully executes on this platform vision, the gap between market expectations and operational reality will close rapidly, driving significant valuation expansion. Conversely, key risks must be weighed carefully by any investor using online investing sites, Fidelity brokerage accounts, or platforms like SoFi Active Investing. If hyperscale cloud providers integrate native agentic workflow tools directly into their core cloud suites at no additional cost, UiPath could face incremental margin compression or extended sales cycles. Additionally, leadership execution remains critical as the company balances disciplined spending with necessary research and development investments. In clean summary, market expectations for UiPath remain weighed down by the false belief that traditional process automation is obsolete. The operational reality, however, reveals a highly profitable enterprise software business with an ironclad balance sheet, deep customer lock-in, and an indispensable infrastructure layer required for safe corporate AI deployment. For investors navigating self-investing options through a Fidelity trading platform, Robinhood stock trading, or an interactive broker's account, UiPath represents a classic expectation versus reality disconnect, where underlying enterprise value far outpaces prevailing market sentiment. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions.